and welcome to Retire Smart Austin. My name is Cynthia DeFazio, and I'm joined today by Philip Donato Capriati Sr. He's President and CEO of Donato Wealth Management and Senior Tax and Insurance Advisors. Philip, it's always a pleasure to see you.
It's good to be with you again today, Cynthia. How have you been?
I have been great. Thank you so much. And I know that you have been great. We've talked about this in the prior weeks, that you've been so busy. The television shows are really doing so well for you and for the firm.
Yes. Over the last 10 years, we've been doing these educational workshops at the local libraries. And since with the COVID-19, they shut the local libraries down. And so we started doing these educational videos for the on TV, and they've been wonderful. So many folks are coming back with very similar questions. It amazes me that many financial advisors don't really educate their clients as much as they really should. And it also amazes me that they don't talk about tax-advantaged retirement income planning. So I guess all advisors aren't created equal, but we like it, we enjoy it, and so does our knowledgeable and friendly staff at the office.
Absolutely. And I know, Philip, that it's always been a passion for you to educate. That's really what you love, is to help people navigate through the often scary time, which is retirement. Without a plan, if you're going into that without knowing what your guidance is, it can be like getting lost in the woods, if you will.
Yep, you're flying blind. And as an educator, so I grew up in a family of educators. Mom, mother-in-law, sisters, aunts, everybody was a teacher in my family except for me. I was the accountant in the family. But it's kind of fun to just kind of sit back and just talk about retirement income planning, tax advantage retirement income planning, active asset management, things that aren't often talked about when most folks talk to their financial advisors at the especially these bigger block shops is what they refer to them as. So we've been having a lot of fun, and TV shows have really brought in quite a few clients. We're enjoying it.
Absolutely. And I wanted to talk to you a little bit, Philip, about one of the shows that we touched in on a little bit was about the difference between a broker and a fiduciary. I know that you received a lot of calls and a lot of questions about that, and a lot of consultations have been booked since then. So I wanted to kind of go over that again today, if you don't mind.
Sure. So when we look at a broker and a fiduciary, and I think we might have there we go, where we have a little a graphic. The difference between working with a fiduciary and working with a broker, you have to understand that many times a broker works for a company. They represent a firm. And even though they manage your assets, their number one priority is working with the firm. Now, these laws are in the process of being changed. In my professional opinion, every financial advisor should be a licensed fiduciary. And sometimes change is slow to come, but it'll eventually get there. So the traditional definition of a broker versus a licensed fiduciary, many folks call themselves fiduciaries but don't actually hold a Series 65 or Series 66 license. It's like saying it's like saying that you're an attorney but you didn't pass the bar exam. Okay, so you have to be licensed. So when we talk about the difference between a broker and a licensed fiduciary, I'll give you the traditional definition. So a broker, as you can see up on the screen, is someone that normally sells products. They normally work for a company. Many times they're compensated through commissions. So they may sell an A-share mutual fund or something of this nature, and when they sell that fund, they get what's called a front-end load or a front-end commission. And that many times, although we don't see them that frequently, many folks, when they come in and let us run a Morningstar report on their portfolio, we can take a look and look at these funds and see if they actually all coordinate. So they're selling products. Normally they're compensated from commissions. They have to follow a suitability rule. In other words, they have to make sure that the product, the financial product they're selling you, is suitable to you, but not necessarily in your best interest, meaning not necessarily the best that's available, okay? Because again, they're working for a brokerage firm. Many times, now the difference between the broker and say the licensed fiduciary works for you.
Okay.
You employ them. They sell a process, and they earn a fee. They may charge you 0.5% or 1%. Basically, you're paying them a fee to work in your best interest. They have to follow a fiduciary standard. A fiduciary standard means always faithful to the client, kind of like Semper Fi.
Okay.
We kind of touched on this in a previous show back. And we also want to take a look at anytime there's a conflict of interest when a fiduciary sells a product. In other words, let's assume you don't have a pension and you may want an insurance product, an annuity, to fill in for part of a pension. A fiduciary has to disclose that they're earning a commission, what the commission is. It has to be put in writing. You have to sign it that you know that the fiduciary has disclosed it. This can be considered a conflict of interest, whereas a broker's not necessarily held to the same standard. Many times brokers, their advice may be a little biased only because their company may offer a certain fund, a proprietary fund sold only by that company.
Okay.
Many times these funds, let's say mutual funds, they're much more expensive than, say, an exchange traded fund, an ETF. And I won't mention any names to protect the innocent, but the difference between a broker and a fiduciary, we can look at a similar, let's say, S&P 500 fund, and it could be in a mutual fund, and it may cost almost 1 basis point or 1% a year to own, whereas if it's in an ETF, it might cost maybe 2 or 4 basis points or a fraction of that to own.
Okay.
So when we run the Morningstar report, which is basically a snapshot or I like to call it a blood test on your portfolio to see how are you working with a broker? Are you working with a fiduciary? Are you working with a dual licensed advisor, someone who's both a broker and a fiduciary? They wear both hats. So when they're selling a product, they put their broker hat on. And then when they're working for you, they put their fiduciary. This is also a very dangerous thing to get involved with. So
Sounds like it.
when you work with an advisor, make sure that they're working on your behalf. Make sure they are a licensed fiduciary, obligated legally to look out for your best interest. That means looking at all the products that are available that are suitable for you and picking and choosing the best product and the best management style, something that coordinates with you, not something that a company is pushing them to sell.
Phil, I have to ask you, if someone is currently working with an advisor and they feel like they have a good plan in place, how important is it to have a second opinion of that plan?
Always get a second opinion. It's basically it's your financial health.
Okay.
So if you had a medical condition that affected your physical health, you would go in naturally and get a second opinion.
Sure.
I think I might have mentioned I had knee surgery about 5 years ago. I got 3 different opinions before I number one, chose the right surgeon to operate, but also chose the right procedure. So I wanted to look at 3 different, and it was kind of funny because all 3 surgeons had 3 different plans and courses of action.
That's interesting.
Same thing with an investment advisor, especially a licensed fiduciary. So we don't like to guess at it. I don't like to push certain products. What I'd like to do is I'd like to run an institutional Morningstar report on every individual that comes into our office. I like to look at their current investment portfolio, even if they're working with 3, 4, 5 different firms. They may have 5 or 6. Some folks will come in with 11, 12 different portfolios, none coordinated together. So we'll run a complete comprehensive Morningstar report, which is designed to outline what is your risk, or what we like to term drawdown.
Okay.
What is your maximum drawdown? How much did that portfolio lose in February and in March when we had the COVID-19 market correction, we'll call it?
Sure.
What is your rate of return? What is your 10-year running rate of return or your 5-year rate of return? And we want to be able to coordinate that. What's your risk? What's your return? How much are the fees? What are your internal fees? How much what is the cost of those funds that you're holding in that portfolio? How much is the advisory fee, or how much are the commissions that you're being charged every time you buy and sell a different investment? Most folks don't understand it. They're not. It's been my experience. We've run hundreds and hundreds of Morningstar reports over the last 10 years. And most of the folks that I talk to when they come in, I'll ask them, has your advisor ever run a professional Morningstar report on your portfolio? And they look like a deer in the headlights and say, no, but we really appreciate it. We now understand it. And then along with that Morningstar report should be an executive summary or a critique of that 60, 70, 80-page Morningstar report to kind of simplify it for you. The do's, the don'ts, and what recommendations would you make to correct or to put you back on the right track.
Well, Phil, we're about ready to open up the phone lines for the first time this week. Can you tell the viewing audience what they can expect to receive by being one of your first 10 callers?
If you're one of the first 10 callers, you'll receive a complimentary Morningstar report and executive summary. Okay, this is a $1,500 value. The other thing that we will do, if you have not filed for Social Security yet, we'll run a Social Security maximization report and actually counsel you. Gregory in our office is our Social Security specialist. He's also our Medicare and Medicaid specialist. So he works with all the Social Security and the Medicare. And in addition to that, we will help you structure a retirement income plan and see whether you have a potential tax problem because maybe you have too much money saved in a 401k, and this is going to cause you a tax problem when you're forced to take RMDs. So basically 3 services: Morningstar report, rate the portfolio; retirement income plan, structure that retirement income plan based on what your family's needs are; Social Security report. How much can I get out of Social Security, and how tax efficient can I make it?
Philip, thank you so much. To the viewing audience at home, the phone lines are now open. The number to call is 888-818-6557. We know you have a lot of questions about planning your perfect stress-free retirement. When we come back, Philip is going to share some more information and guidance for you. Please stay tuned. We'll be right back after this quick commercial break.
Thank you.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
And welcome back to Retire Smart Austin. My name is Cynthia DeFazio, and I'm joined today by Philip Donato Capriati Sr., and he is President and CEO of Donato Wealth Management and Senior Tax and Insurance Advisors. And Philip, a great first segment of the show. I think a lot of questions always surround differences between a broker and a fiduciary, and you do such a wonderful job of really delivering that information to the viewing audience.
We certainly do. We really enjoy it. When folks come in for their complimentary consultation, in many cases, we'll visit with them 3 or 4 times, and there's no charge for these. We truly want them to understand their plan, and we want them to understand their portfolio. Whether they work with us or not is really irrelevant. Of course, we like to work with folks, and we like to get new clients through these TV shows, but our number one priority is to leave the client better off with, when I say better off, knowing more about their portfolio and how it's being managed.
Okay.
Okay.
Can I ask you about that? I'm sorry to interrupt
No,
you,
go right
Philip,
ahead.
because I
Go
wanted
right
to
ahead.
talk to you a little bit about your style of asset management. Do you do more of a tactical approach, if you will?
Yeah, so tactical asset management, as this is also known as active asset management. So basically there are three very popular types of asset management. Old school management is more of a passive management. Passive management is your investment advisor may rebalance your portfolio every 3 months, but they really don't change a lot of the investments inside of it. So they may sell you a stock fund, they may sell you a group of mutual funds or individual stocks, and they basically break it up into percentages. So with a passively managed portfolio, you may have 30% in domestic stocks, you may have 15% in international stocks, you may have 40 or 50% in a bond fund or different types of bond funds. And they basically, based on the questions that you ask them, they give you, I refer to it as a paint by number portfolio.
Okay.
This is old school management. We've been doing this for decades.
Okay.
Nowadays, when we're managing an IRA and we're looking to actively manage a portfolio, especially when we're executing Roth conversion strategies, it's extremely important that these portfolios are tactically or actively managed.
Okay.
So passively managed, you're basically painting the number. In fact, I think we have a graphic that we can
good.
pull up. With a passively managed portfolio, this is where your manager buys a certain percentage of stocks, bonds, and you keep them for a long time regardless of the market.
Okay.
The problem with these is they're normally unlikely to outperform the index, whatever your index you're using, the S&P index. The reason is the participants share in all of the downside of the market. That's not so with active. So with another form of active management is day trading. I call these the crazy folks. They're buying and selling every day, and this is becoming popular. Most actively managed portfolios that are day trading also aren't very successful. It's active, but again, you're buying and selling, getting in and out, and staying in less than 1 day.
Okay.
We do not specialize in that. Our approach is using algorithm-based portfolios to actively manage. We want to see where the money's going to and coming from. We want to sit down and have an interview with a client, and I want that client to say, I'll ask them, if your portfolio, you have $1 million in your portfolio, and your drawdown after we run a Morningstar report is 30%. So if your portfolio loses 30% or $300,000, but you're making an 8% return, is that an acceptable drawdown or acceptable loss for you? And most clients that are in retirement or getting ready to retirement will tell me no. So this is one of the reasons we run the Morningstar report.
Sure.
So what we want to do with an actively managed portfolio is we want to draw a line in the sand for with the client to understand what is their loss, their maximum loss. What is it? What's the getting sick to my stomach when I saw my portfolio lose 10% in February, 20% in March during COVID-19? So normally we find drawdown is normally somewhere between 7 and 10% for folks reaching retirement. So with that, we want to buy and sell asset classes and investments based on the current economic cycle, the current business cycle, current legislative or even tax cycle. We want to move in and out of certain asset classes that are within our client's risk tolerance to get the best return for the least amount of risk.
Okay.
We want to hit that quadrant. That we want to get high return, low risk based on what our clients' risk tolerance is.
Okay.
So this is tactical. You don't guess at it. You don't throw darts at it. We actually use a theory called modern portfolio theory. Modern portfolio theory was a theory you'd study in college if you're in finance, and it was based on a PhD by the name of Harry Markowitz. And Harry said, with modern portfolio theory, during every cycle, every business cycle, every economic cycle, every legislative cycle, there is the best group of assets to get the best return for the least amount of risk. So the algorithm we use to execute a tactical actively managed portfolio is based on modern portfolio theory. And most of our clients, for instance, in February, March, in our conservative portfolio, their portfolios didn't see more than a 7, close to 8% drawdown. Where some portfolios lost 25, 30%, we were down about 7, 8%. Now, the reason we want to limit drawdown is eventually the market is going to hit a trough. It's going to hit a bottom. And when it turns the corner, recovers, we want to recover from an elevated position. I don't want to lose 20, 25, 30% and spend months or maybe even years getting back to even. I want to, on that rebound, grow the investment portfolio, and this is why I want to limit my drawdown, and this is why we specialize in tactical asset management.
Philip, thank you so much. We're about ready to open up the phone lines for the second time today. Can you tell the viewing audience what they can expect to receive by being one of our callers?
Call our office, call 888-818-6557, and what we will do is we'll set up a complimentary consultation to provide you with, number one, a comprehensive Morningstar report and executive summary. We'll check your retirement income plan. If you do not have a written retirement income plan that includes a Social Security analysis, an analysis of what benefits you can receive from Social Security at every age, we'll provide that for you additionally. This is a $1,500 value. Take advantage of our expertise and our knowledgeable office staff, and we'll provide this service to you free of charge.
Philip, thank you so much. To the viewing audience at home, the phone lines are once again open, and that number to call is 888-818-6557. We know the phone lines have been busy in the past, so we've added an additional phone line for your convenience. Again, it's 888-818-6557. We'll be right back after this very short commercial break with questions and answers for Philip about planning your perfect retirement. Please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to Retire Smart Austin. My name is Cynthia DeFazio, and I'm joined today by Philip Donato Capriati Sr. He is President and CEO of Donato Wealth Management and Senior Tax and Insurance Advisors. And another wonderful show, Philip. But I have to tell you, this is my favorite part of the show because as we're here talking and the phone lines are lighting up, viewer questions are coming in as well. So do you mind if I jump right into a viewer question?
No, please do.
Okay.
Love questions.
We had a caller from Marble Falls, and the caller asked, do you only use tactical asset management? When is this scenario good for someone and when is it not?
That's a great question. Okay. They should definitely call and make an appointment to come into the office. So tactical asset management is designed to change portfolios. Like, for instance, give you an example. This year, we've had a very active market, very robust, up and down.
Sure.
We had 7 portfolio landscape changes. That's active. This is where we've sold 4, 5, 6, 7, a dozen different assets in a portfolio, and then moved to either cash, treasuries, and then bought back certain assets. That happened 7 times. Normally, on average, we're buying and we're selling normally somewhere between 6 and 12 times a year. depending on what's going on in the market.
Okay.
Every time we buy an asset or sell an asset, there are no trading fees, there are no commissions. So the first thing a client will say, well, you're buying and selling, you're getting commissions. No, it's all included in your very small, reasonable monthly fee.
Okay.
So anytime we buy or sell. Now, these should be done specifically when we're looking at an IRA, a 401k, or a Roth IRA.
Okay.
Now, the reason that we want to use tactical asset management in an IRA or Roth IRA is no matter how often we sell and buy different classes of assets, we're not creating a tax issue, a negative tax consequence.
Okay.
In a regular joint account or taxable account, buying and selling and using tactical asset management really is not, it can cause significant tax problems. It can cause a lot of short-term and long-term capital gains. We don't want to cause a tax problem. I'm a tax advisor. My job is to help you lower your tax bracket, not exacerbate the problem.
Okay.
So tactical asset management is used strictly when we consider a Roth IRA, when we're managing a 401k, when we're managing a Roth IRA, especially when we're managing Roth conversions. So over the last 10 years, our office has specialized in helping folks convert from a tax forever IRA or 401k account to a tax-free account using a Roth conversion. Once you pay the tax on the conversion, moving it from an IRA, taxable IRA, to a tax-free Roth, the last thing you want is to pay a 20% tax and then see the market take 30%.
Sure.
So it's extremely important to actively or tactically not only manage the taxes, but manage the investment account to make sure you're limiting drawdown, limiting volatility, but maximizing return within your specific risk tolerance, whether it be conservative, growth, moderate, balanced, aggressive.
Philip, thank you so much. What an amazing answer. And I thought that was a great question as well.
Yep.
We have time for one more question. It comes from Kingsland. It says, I have not started my own retirement plan. Philip, I am 5 years away from retirement. Is it too late for me to start?
No, it's never too late. And if you're working full time, what I would recommend is start to, and again, depending on your income, depending on your expenses, start maxing out the company benefits. If the company has a 401k, you want to start maximizing your contributions. Contribute the max. If you have other assets involved, if you're in a low tax bracket, start putting money into the Roth 401k while you're in a 10% or 12% tax bracket, because taxes will probably go up 50, 100, even more as our debt gets up over $30-35 trillion. We're mainly concerned with taxes increasing. So focus on saving the max and put it in a tax-efficient or tax-free account.
Philip, thank you so much. To our viewing audience at home, thank you so much for watching today. It's a pleasure to spend time with you. We hope you have a blessed, happy, safe, and healthy week ahead. See you soon.